What if I told you that one of the richest men in America, a man worth over $60 billion, built almost his entire fortune without ever buying a single share on the stock market? No day trading, no IPO flipping, no meme stocks, no crypto. Charles Koch took his father's $21 million company and turned it into a $125 billion empire by owning real things: pipelines, refineries, ranches, timber, fertilizer plants, chemical facilities, paper mills, things you can touch, things you can walk through, things the world literally cannot function without. And here is what is crazy. Most people have never even heard of Koch Industries because it is a private company. It does not trade on any exchange. There is no ticker symbol. There are no quarterly earnings calls for Wall Street analysts to pick apart. Charles Koch deliberately chose to stay private because he believes the public stock market forces short-term thinking, and short-term thinking destroys long-term value. Now, I am not telling you to ignore the stock market entirely. That would be impractical for most of us. But I am telling you that Charles Koch's philosophy on what to own and why to own it can radically change how you build wealth. And at the center of that philosophy is one massive question that almost nobody asks themselves. Should you own real assets or should you own stocks? And what is the actual difference? And does it even matter? By the end of this video, you are going to understand exactly what real assets are, what stocks really represent, where they overlap, where they diverge, and most importantly, what you should actually own based on principles that built one of the largest fortunes in human history. So let us get into it. First, let us define what we are actually talking about, because most people throw around the term real assets without really understanding what it means. A real asset is something that has intrinsic physical value independent of any financial system. It exists in the real world. You can see it, you can use it, it produces something, or it holds value because of its physical properties. Farmland is a real asset. You can grow food on it. Timber is a real asset. Trees grow whether the stock market goes up or down. Oil in the ground is a real asset. A pipeline that moves that oil from point A to point B is a real asset. A factory that manufactures goods people need is a real asset. Gold sitting in a vault is a real asset. A warehouse full of copper or lithium or fertilizer is a real asset. Real estate, whether it is a rental house or a commercial building or a piece of undeveloped land, is a real asset. These things have value because they are useful, scarce, and necessary. They do not need a stock exchange to validate their worth. They do not need a ticker symbol or a market maker or a trading algorithm. They just exist and they produce value. Now let us talk about stocks. A stock is a piece of paper, or more accurately, a digital entry in a brokerage account that represents partial ownership of a company. When you buy a share of ExxonMobil, you do not own a barrel of oil. You do not own a refinery. You do not own a pipeline. You own a fractional claim on the future earnings of a corporation that happens to operate refineries and pipelines. That is a very important distinction. You own a financial claim, not a physical asset. Now that financial claim can be incredibly valuable. If the company earns profits and grows over time, your share becomes worth more. If the company pays dividends, you receive cash flow. If the company buys back shares, your ownership percentage increases. Stocks can absolutely build wealth. The historical return of the S&P 500 is roughly 10% per year over the last century. That is powerful compounding. But here is what Charles Koch understands that most retail investors do not. A stock is a derivative of a real business. It is one layer removed from reality, and that layer of abstraction introduces risks that real assets do not carry. The stock price can disconnect from the underlying business value for years at a time. Market sentiment, algorithmic trading, media narratives, Federal Reserve policy, political events, and pure speculation can drive stock prices in directions that have absolutely nothing to do with the actual cash flow of the business. You can own a wonderful company and watch the stock drop 40% because some hedge fund is unwinding a leveraged position. That does not happen with farmland. Nobody panic sells a wheat field because the Federal Reserve raised interest rates by a quarter point. This is why Charles Koch has always preferred to own businesses outright rather than own shares of businesses on an exchange. When you own the whole business, you control the capital allocation. You decide how much to reinvest. You decide when to expand. You decide when to acquire another company. You decide when to cut costs. You are not at the mercy of quarterly earnings expectations or activist investors or short sellers. You are the operator and the owner simultaneously. That alignment of incentives is incredibly powerful, and it is one of the core tenets of Koch's market-based management philosophy. In the public markets, that alignment almost never exists. The CEO owns maybe 1 or 2% of the company. The board of directors is worried about optics. The analysts want steady, predictable numbers every quarter, and the actual long-term health of the business takes a backseat to short-term stock price performance. Koch recognized this dysfunction decades ago and decided he wanted no part of it. But here is where it gets practical for you and me, because most of us cannot buy an entire oil refinery or a paper mill or a 50,000-acre ranch. We do not have billions of dollars. So how do we apply Koch's real asset philosophy with a normal portfolio? The answer is you blend both. You own real assets directly where you can, and you own stocks that behave like real assets where direct ownership is not practical. Let me explain what I mean by stocks that behave like real assets. Think about a company like Enterprise Products Partners. Their entire business is owning and operating pipelines, natural gas pipelines, crude oil pipelines, NGL pipelines, storage facilities, processing plants. These are massive physical assets bolted to the ground. They are not going anywhere. And the business model is essentially a toll road. Energy producers pay Enterprise a fee to move their product through the pipeline. It does not matter if oil is $40 a barrel or $100 a barrel. The pipeline still collects its fee. The cash flows are stable and predictable. The company pays a distribution yield of around 7%, and it has increased that distribution for over 25 consecutive years. When you own Enterprise Products Partners, you are as close to owning a real asset as you can get in the public markets. You effectively own a piece of America's energy infrastructure. That is Koch-style investing in a publicly traded wrapper. Compare that to owning shares of some software company that has never turned a profit, trades at 200 times revenue, and could be obsolete in 5 years when the next technology wave hits. That is not a real asset. That is a speculation on future possibilities. Charles Koch would not touch that with a 10-foot pole. He wants things that produce cash flow today, that are essential to the functioning of civilization, and that have durable competitive advantages that do not evaporate when consumer preferences change or a new competitor enters the market. Let me give you another example. Farmland. This is one of the most Koch-aligned investments you can make. Farmland has produced positive returns in 40 out of the last 50 years. It has almost zero correlation with the stock market. It provides both income through crop production or rental payments and appreciation as land values increase over time. It is a finite resource. They are not making more land, and the demand for food only goes up as the global population grows. Charles Koch owns agricultural operations through Koch Industries. Bill Gates is now the largest private farmland owner in America. These billionaires are not buying farmland because they think it is trendy. They are buying it because it is the ultimate real asset. It produces something essential, it holds value through inflation, and it compounds quietly over decades without any of the drama of the stock market. Now, you do not need to buy a 1,000-acre farm. Platforms like AcreTrader and Farm Together allow you to invest in farmland with minimums as low as $10,000 or $15,000. You get exposure to the asset class without having to operate a tractor. Timber is another incredible real asset that most investors completely ignore. Weyerhaeuser owns approximately 11 million acres of timberland in the United States. Trees grow every single day regardless of what the stock market does. If lumber prices are low, you simply let the trees keep growing. They get bigger and more valuable. If lumber prices spike, you harvest and sell at premium prices. It is one of the only investments where the underlying asset literally grows on its own with zero human intervention. Koch Industries understood this when they acquired Georgia Pacific, which is one of the largest forest products companies in the world. That acquisition gave Koch access to millions of acres of timber, paper mills, and building product manufacturing. It was a classic Koch move: buy a real asset that produces essential products and own it forever. Now let me address the elephant in the room. What about inflation? This is where real assets absolutely crush financial assets. When inflation rises, which it inevitably does over long periods of time, the prices of real things go up. The price of oil goes up, the price of food goes up, the price of land goes up, the price of timber goes up, the price of metals goes up, the price of fertilizer goes up. Real assets are natural inflation hedges because they are the things whose prices are rising. Stocks, on the other hand, have a mixed relationship with inflation. Some companies can pass on higher costs to consumers and maintain their margins. These tend to be companies with pricing power like the ones Koch would invest in. But many companies cannot pass on costs and their margins get squeezed and their stock prices suffer. During the high inflation period of the 1970s, the S&P 500 went basically nowhere in real terms for an entire decade. Gold, on the other hand, went from $35 an ounce to over $800. Farmland values doubled and tripled. Oil prices surged. Real assets won that decade decisively. And if you believe that we are entering a period of structurally higher inflation due to government spending, deglobalization, energy transition costs, and demographic shifts, then tilting your portfolio toward real assets is not just smart, it is essential. Let me talk about another Koch principle that applies directly to this real assets versus stocks debate: opportunity cost. Charles Koch thinks about opportunity cost obsessively. Every dollar you invest in one thing is a dollar you cannot invest in something else. So you have to constantly ask yourself, what is the highest and best use of this capital? Right now, in this current environment where interest rates are elevated, where geopolitical instability is increasing, where supply chains are being restructured, and where commodity demand is rising due to infrastructure spending and energy transition, real assets look incredibly attractive on an opportunity cost basis. The risk-reward profile of owning essential physical assets that produce cash flow and hedge inflation is arguably better than owning overvalued growth stocks trading at historically high multiples. That does not mean you should sell all your stocks tomorrow. It means you should be thoughtfully allocating more capital toward real asset exposure than most financial advisors would recommend. Most financial advisors will tell you to put 60% in stocks and 40% in bonds and call it a day. Charles Koch would laugh at that allocation. He would say, where are the pipelines? Where is the farmland? Where is the timber? Where are the mineral rights? Where are the things that actually produce something the world needs? Let me give you a practical framework for how to blend real assets and stocks in a way that Charles Koch would respect. Start with your core. 30% of your portfolio should be in what I call real asset stocks. These are publicly traded companies that own and operate essential physical infrastructure. Pipeline companies like Enterprise Products Partners, Kinder Morgan, and Enbridge. Commodity producers like Chevron, Canadian Natural Resources, and ConocoPhillips. Agricultural companies like Archer Daniels Midland, Nutrien, and CF Industries. Timber companies like Weyerhaeuser. Industrial gas companies like Linde and Air Products. These stocks give you exposure to real physical assets with the liquidity and accessibility of the stock market. Next, allocate 20% to direct real assets if you can. This means physical real estate, whether that is rental properties or commercial property. Farmland through direct purchase or through platforms. Gold and silver, either physical bullion or allocated accounts. Mineral rights, if you can find them. These assets sit outside the stock market entirely and provide true diversification. Then allocate 30% to what I call Koch compounder stocks. These are companies with high returns on invested capital, strong competitive moats, owner-operator management, and a track record of intelligent capital allocation. Think Berkshire Hathaway, Danaher, Constellation Software, Illinois Toolworks, and Parker Hannifin. These are businesses that compound value year after year by reinvesting profits at high rates of return. They may not be physical asset businesses themselves, but they operate with the same discipline and long-term orientation that Koch applies. Keep 10% in essential industry stocks like building materials, chemicals, and defense. Companies like Vulcan Materials, Martin Marietta, LyondellBasell, and TransDigm. These produce things that are absolutely necessary and have significant barriers to entry. And finally, keep 10% in cash or short-term treasuries. This is your dry powder. Charles Koch has always maintained the ability to act quickly when opportunities arise. When markets crash and quality assets go on sale, you need capital available to deploy. If you are fully invested at all times, you miss the best buying opportunities. Koch made some of his greatest acquisitions during periods of maximum fear and distress. You should be ready to do the same. Now I want to address a counter-argument that I know some of you are thinking. What about technology stocks? What about the Magnificent Seven? What about AI and innovation? Aren't those the future? Here's what Koch would say. Innovation is real and it does create value, but most of the value creation in technology accrues to a very small number of winners, while the vast majority of technology companies fail or become irrelevant. For every Apple, there are 10,000 dead startups. For every NVIDIA, there are hundreds of chip makers that went bankrupt. The survivorship bias in technology investing is extreme. Meanwhile, the companies that produce oil, food, fertilizer, building materials, industrial gases, and timber have been doing it for decades and will continue doing it for decades more. The world is not going to stop needing energy. The world is not going to stop needing food. The world is not going to stop needing houses and roads and bridges. These are permanent needs served by real assets, and the companies and assets that serve these needs generate real cash flow today, not projected cash flow in some hypothetical future scenario. Koch would rather own something that makes money right now and will make money for the next 50 years than gamble on which AI company might dominate a market that does not fully exist yet. Let me leave you with the most important insight from Charles Koch's entire investing philosophy. The purpose of investing is not to get rich quickly. It is not to beat the market every quarter. It is not to brag about your returns on social media. The purpose of investing is to build durable long-term wealth that survives every economic cycle, every market crash, every inflation spike, every geopolitical crisis, and every technological disruption. Real assets do that. They have done it for thousands of years. Land has held value since the beginning of civilization. Gold has held value since the beginning of civilization. Commodities have held value since the beginning of civilization. The stock market has existed for a few hundred years. Index funds have existed for about 50 years. Cryptocurrency has existed for about 15 years. When you zoom out and take the truly long-term view that Koch takes, real assets are the foundation of all wealth. Stocks can be a wonderful tool for compounding on top of that foundation, but the foundation must be real, it must be tangible, it must be essential. That is the Koch way. Own what matters, own what lasts, own what the world cannot live without, and hold it forever. That is how you build wealth that survives generations. If this video changed the way you think about investing, hit the like button and subscribe, because I am going to keep breaking down billionaire investing frameworks that you can actually apply to your own portfolio. I will see you in the next one.